Well, good morning and welcome to the Spheria webinar on M&A targets for Australian small caps. My name is Mark Cormack from Pinnacle Investment. Pinnacle are equity partners and work alongside Spheria to distribute the Spheria small and micro cap funds to the Australian financial advisory marketplace. And joining us on today's webinar are both the founders and lead portfolio managers of Spheria, Marcus Burns and Matthew Booker. In brief, Spheria are an independent fund management boutique who specialise in small and micro cap investing. The Spheria micro-cap fund has delivered a return of 20% over the last year and 17% per annum since inception, outperforming both the ASX Small Ordinaries Index and the Emerging Companies Index. And the Spheria Small Companies Fund has delivered a return of 27% over the last 12 months and a 15% per annum return since inception, again outperforming the ASX Small Ordinaries Index. It's important to outline that those returns that the Spheria team have delivered have been without holding the hyper-popular stocks in their portfolio, stocks in their portfolio that are on eye-watering valuations such as A2 Milk, WiseTech and Afterpay. In addition to the managed funds, Spheria also manages the Spheria Emerging Companies Listed Investment Company, which is another way to access Spheria's investment capabilities via an LIC. The ASX code for that is SEC. Before we kick off today's webinar, just a couple of quick housekeeping items. Our presentation should last around 15 to 20 minutes, and all attendees have the opportunity to ask questions by clicking the chat box on your screen. So without further ado, I'll hand you over to Matthew Booker and Marcus Burns for today's presentation. Thanks, guys.
Thank you, Mark. You sold our fund as usual. Our total fund has reached about 700 million now, so we're at a scale size in the market. We tend to get a look in on any IPOs and raisings, etc. So, we're very relevant in the market. We've added a couple of new members to the team, so two new guys, Ollie Coulon and Al Docky. They're both very productive assets for us, and we see good futures for them in the team. The small cap fund has delivered a strong return over the past year. It's up 27% after fees, which beat the benchmark to the end of May. A lot of the market has been driven by some of the larger cap stocks in the small cap market. So the small cap fund has benefited from that move to some of the larger stocks. The micro cap fund has trailed the small cap fund in the last year, whereas previously it had beaten it. So it's up 20%, which is about a 5% underperformance versus the benchmark. But we have seen microcaps generally underperform over the past year. We've always said that we'll limit capacity in the funds, and we're sticking to that. And the microcap fund is effectively soft closed to retail investors. Just moving on to slide 3. We have had some changes in the portfolios in the recent months. So Certex, for example, was a large holding in the small cap funds. We've cycled out of Certex and we've moved into some new names. So we've increased our holdings in Tech1, which is a fantastic software company. It's the cheapest it's been in about 5 years, and yet over that time frame, its earnings growth has been simply stellar. We believe the outlook for Tech1 is very positive, and so we've increased our holding after the result. Fletcher Building is a new holding in the fund. We built into that stock pre the capital raising, and we took more in the capital raising. We believe the capital raising will significantly de-risk that business going forward, and we believe there's some asset sales which can add significant value to the business. The media sector has been interesting. There's been a couple of deals, particularly in the outdoor space, and we can see more consolidation in that market. We own a couple of media stocks, and we'll talk about them later on in this presentation. But we expect M&A activity to remain elevated in 2018. Organic growth prospects are fairly weak across the board. The economy is kind of just trundling along. It's not growing at rapid rates, and there's a lot of competition in the market. So we see strategic acquisitions as being, salient over the next 6 months. Also, the popular companies have a lower cost of capital. Intrinsically, if they're trading at a higher multiple, they can raise money quite cheaply to buy other assets. And in a weaker growth environment, that's what they tend to do. The foreign corporates are obviously quite active in that outdoor sector. JC&Co has obviously had a crack at APO, which is APN Outdoor, the outdoor company. So you see that foreign money is coming into the market. Also, private equity companies are sitting on large cash reserves, and we talked about that before. What we have witnessed in the market has been this flight to the hyper-popular companies, and some of those multiples are now very stretched. We're very wary of investing in that end of the market. We're very focused on valuation, but also finding companies that have sustainable advantage and strong cash flow in nature. I'll pass on to Marcus now to talk about the next slide.
Yeah, thanks, Matt. It's Marcus Burns here. So obviously the catch cry of the webinar is what to look for and what we're looking for in terms of how we invest. Obviously, there has been, as Matt alluded to, with Certex and AWE earlier in the year, a couple of stocks that we've held in the portfolios more recently, but also back through the history of the portfolios have been taken over by foreign corporates and by private equity. And really, it's not a major surprise to us because the key things we're looking for, in many cases, dovetail with the kind of targets and acquisitions that are appealing for both private equity and corporates alike. So just to remind everyone here, obviously, one of the core parts of our process is we look for free cash flows. We talk about investing in quality companies. Now, what does that actually mean? We talk about quality as being a company that can sustainably generate free cash flow through a cycle. We like cash flows because it allows you to pay down debt, pay dividends, make acquisitions, buy back stock, but also fundamentally enables you to value the company. Matt and I find it difficult to value businesses without something like a yardstick like cash flow. And I think it's a common language, if you like, for looking through industries and cycles and making sense of the stock market in a long-term sense. So we look at sustainable or cash flows that are predictable, preferences for businesses that are lowly regulated and can control their own destinies. We spend a lot of time debating as a team industry structure. So we employ the Port of Five Forces model, which is fairly simplistic, but actually it's a really good way for us to look through and determine whether there's pinch points in suppliers, in negotiation with labour unions, anywhere along the value chain that might squeeze returns or impact the valuation of a company. We spend a lot of time debating that amongst us, and in many cases quite vigorously. But all that is designed to do is try and give us a sense of how do we distinguish cash flows and sustainability of cash flows between companies, industries, and businesses. And then finally, we are trying to minimise risk. Obviously, part of the return has two profiles. One is risk and one is return. And we're trying to maximise returns for clients whilst also controlling risk. And so to that end, as many of you know, we do focus on businesses that make cash flows because we think, one, they're lower risk than ones that do not. And secondarily, we try to buy businesses and have a strong preference for companies that have low gearing on their balance sheets and or low operating leverage, which we feel can materially increase or decrease the risk of a company. So we weigh off all these factors in our portfolio construction. Obviously, the highest weightings in the portfolios over those stocks that tick all the process boxes and a lower risk, and the ones that are slightly higher risk, if we still see valuation upside, we might have them in the portfolios, but there'd be a commensurately lower weight in portfolios. Turning on to page 5. So with that in mind, where do we see risk in the marketplace right now? Well, as Matt alluded to earlier, there's a couple of things that have gone on in the small cap market over the last 12 months. It's been a very strong market for small caps that have dramatically outperformed the large caps. Large caps have come back a little bit, smalls have performed particularly well. But within that universe, there's been a bit of a bifurcation. So the top end, anything with earnings momentum or upgrades, has seen a dramatic re-rating. And by that I mean, in some cases, it's almost doubled the share price, and in many cases more over the last 12 months, based on very little more than minor increases to their earnings forecasts. At the bottom end of the spectrum, we talked about this earlier back in January, February, we've seen a lot of risky stocks actually being sold off quite aggressively. So the chart we have on page 5 there just gives you the number of stocks in the small ordinaries index that have market capitalisation over 100 million and less than $2 million in revenue. So if you like lots of market cap and very little fundamental valuation to support that, and as you can see, that chart peaked back in January at 52 names, has since come back down to about 38 names. So quite a few of those stocks have fallen dramatically. The aggregate performance of those 52 stocks, if you had an index of those names, is down about 16% since the end of January to the end of June. So, and many of those stocks have been suspended, and a couple have fallen back to zero. So there's been a dramatic fall in the bottom end of stocks that have no cash flows. And so obviously that we still think that area is pretty risky, and we avoid those in our process because they do not meet the basic criteria of having cash flows or balance sheets that we think are attractive. So turning now to a couple of stock examples to give you, some examples of how our process works in action.
Okay, yeah, just talking about HT&E. It's got a funny name, so you probably don't know what it owns, but it owns Adshel, which is a street furniture advertiser, and it also owns radio assets, ARN, which owns Kiss FM, for example, and Classic Hits WSFM. So it's got some key assets in the portfolio. We've owned it for a number of years, and its popularity has waxed and waned. But if you look at that chart on the bottom left there, you can see why we like it. The cash flow conversion in this business is fantastic. So the dark blue is the free cash flow, and the light blue is the earnings. And you can see that the cash flow has been strong for a long period. Now, it looks like it's been declining. The decline is actually because they've sold assets. So a few years ago, they sold APN Outdoor to private equity. And now that came back, it got recycled back into the market, was listed separately. They also sold NZME, so that was a demerger of NZME, which is the New Zealand operations. Basically, it left them with two core assets, Adshel and ARN. What you've seen in recent periods is there's been a lot of strategic interest in Adshel. So the stock price of HT1 collapsed probably 6 months ago, fell to $1.50. It became very attractively valued, and obviously the suitors started to look through the assets. Adshel was the most interesting asset to some of the outdoor players, and you saw a couple of bidders for that asset. Ultimately, Media has won the battle for that, and they're paying a big price, $570 million. Now, there is some risk with this deal getting through the ACCC because in parallel to this, JCDecaux's bid for APN Outdoor, which HT1 used to own, and it will mean significant concentration in the outdoor market, where you go from basically 4 players in the market to 2, and the concentration of the market will go, be heavily concentrated in 2 hands. You'll have 2 players with about 90% of the market. Now, the reason it can get through is because they operate in different verticals in the outdoor space. So Adshel is in the street furniture space, whereas Media is in the big, the big billboard space. So there is some separation there. They don't naturally compete against each other. And because it is a complementary acquisition, it may actually get through the ACCC. It's probably a 50-50 bet at the moment. But apart from that, even if the deal falls over, we believe there's significant value in HT1. Both assets produce a lot of cash. Both assets are growing, so radio's growing, and the outdoor street furniture business is growing as well. So we think there's still good value in the business, even if this deal falls over. Moving on to slide 7. Prime Media, which you probably aren't aware of, it is the regional affiliate for Channel 7. So it basically resells Channel 7's basically programming into the regional markets. The only market it doesn't operate in is Queensland, where Channel 7 actually owns the regional licence. Now, there were some rule changes last year that should benefit Prime in the fact that the media legislation changed, allowing the main metro channels to buy their regional affiliates. And we haven't yet seen anyone move on that front, but we believe it will probably happen at some point. The reason for that is for 7 West, for example, which we ironically own in the small cap fund, we believe it is a de-risking of their portfolio. Currently, they get about $100 million from Prime Media as a royalty for the programming costs, and that is about 1/3 of 7 West earnings. So actually owning Prime Media effectively de-risks them. Now, there's some views out there that the affiliate fee will increase substantially on renewal. It renews next year, and they'd currently be in negotiations on that front. We point out that actually Prime is very important to 7 West, and that and it goes both ways, so it's reciprocated. Now, under the current agreement, if they can't come to an agreement on a affiliation percentage, the actual current license renews at the same rate. So we see that the fallback is actually that the license just renews at the same rate, and Prime will continue to earn the money that they're earning. They currently earn about 40 to 50 mil of EBIT. The stock is trading on 2.5 times free cash flow. So if Channel 7 actually were to purchase Prime and they paid a premium, even if they paid 3 or 4 times free cash flow, they'd be getting a 25 to 30% return on capital, which is significant return on capital and is obviously very lucrative for them. So we actually think there's a persuasive argument and a compelling argument for Channel 7 to take out Prime. In any case, we're buying Prime cheaply, but we could see the case where there is Channel 7 taking it out for a premium, and it's accretive for both parties and de-risking for Channel 7. So we've got a significant position in Prime, and we think the outlook is actually pretty robust.
It's quite a lot of cost savings as well. If they did merge it probably as well.
Yeah, there's $10 million of cost synergies in Prime for Seven. So the actual return on capital would be significantly higher than 30 to 40%, potentially up to 50%. So basically, they could earn their money back in 2 years by taking out Prime, even at a premium.
It's pretty compelling.
Yep.
Okay, now to page 8, just gives you a quick summary, quick snapshot of the performance of the funds to the end of May. Now, the reason we haven't given these numbers at the end of June is the final unit price is still being figured out, basically, because of the year-end distributions. But you can see there, just to Matt's point earlier on in the introduction, the small cap performance has been better than the micro caps over the last 12 months, largely because of the exposure to a few of those stocks that have been taken over, and the larger end of that small cap space has performed better than the smaller end. Micro caps generally have been a more challenging part of the market to be playing in. The absolute return of the micro cap fund has been pretty strong, but it has lagged the market over the last 12 months. But we see actually quite compelling value now in the micro cap end versus the larger end of the small cap. So the multiples are more attractive towards the smaller end, ironically, because obviously they've performed less well than the larger end. So we think both funds should do okay going forward. Most importantly, we haven't taken what we think is excessive risk to get the returns, and I think that's a really important point to drive home, is that we don't punt in momentum stocks. We're not buying stocks we see them moving up just because they're moving higher. We do a lot of work on the stocks we own in the portfolios with a lot of debate and valuations around to drive our process and our returns to clients. On page 9, quick snapshot of the top 10 holdings of both funds. I think really the 2 or 3 key points to drive home here are that if you look back at these holdings, say 3 or 4 months ago, we had a very large position in Certex in the small companies fund, which was under takeover. We've since exited that position at a very healthy profit for our clients, and reinvested those proceeds, as Matt kind of alluded to earlier on, in things like HT&E, Fletcher Building, and Technology One, all of where we see compelling opportunities and fairly low risk situations. Most of those have net cash balance sheets or a de-gearing in the background, and we think the cash flow generation profile of all those assets is attractive. And in micro caps, the portfolio hasn't changed quite as dramatically because there hasn't been the same degree of takeover activity, but we've added a specialty fashion group to that holding. Once it exited 4 or 5 of its old brands, basically with massive legacy lease issues and low earnings, we found the remaining asset of City Chic very attractive and very attractively priced. We bought that for the funds. And then we've increased our stake in Gage Roads Brewing, which is a micro brewer based over in Perth. It's going through a big self-help, and it's made an acquisition recently. We've increased the weighting of that stock, and it's performing pretty well for the funds. Just to conclude, on page 10, the team has a strong performance in micro and smalls, and we remain very focused on controlling risk, despite the fact it's been a bit of a go-go market. Our process is very risk-aware, and we will close funds when we get to capacity in order to preserve performance for clients that have invested with us and trust us with their capital. And of course, all the team are both invested in the funds and obviously very aligned with clients and investors who come into our funds.
Fantastic, guys. Always great to get your insights on the small and micro cap market and your view on potential M&A targets within that market. We have had a few questions come in, so I might kick off with those. Guys, talking M&A, do you really go out and deliberately seek to look for some of those M&A targets?
Look, I think it's just an outcome of the process. We always do that 4 to 5 forces check on the industry structure, and we look for companies that are strategically well positioned. And ultimately, we're buying companies that generate good free cash flow. So all those tick the box for any suitor, and the byproduct is that we get takeovers in the fund. The problem we have is then we have to redeploy, and it's getting harder to find new ideas. I mean, some of the acquisitions that have taken place have taken good companies out of our portfolio. But we're always searching, and we always tend to find something under a rock somewhere.
Good answer. Guys, it looks like it's been a momentum market. What do you think's been driving this, and do you take momentum into account with your investing?
Thanks, Mark. No, we do not take momentum directly into account with investing, obviously. We, as you can probably gather by all the sort of process we discussed earlier on, we focus very much on bottom-up valuations. Obviously, we're aware that the market has a fairly strong momentum factor behind it at the moment. And so if we own a stock and it's performing well, we might be reducing it if it gets expensive, and we'll let momentum take the share price up, but we won't buy on the back of momentum. We'll use it to sell or exit a position over time, I think, at higher prices, but it's not part of our core process.
Okay, turning to stock-specific questions, we've had a couple of questions come in on Class, CL1. Main question, Class has been in the portfolio, generates some great cash flows, has a great lock-on clients. Could it be an M&A target? And another question in there, are you concerned about any increased competition with Class?
Yeah, look, there has been an increase in competition. Obviously, BGL is the incumbent desktop provider. It's got about 40% of the market. It was late to the party with its cloud product, but it is out there with a cloud product. And because they've been losing so much share from the desktop to Class, about 2/3 of Class's customers every quarter come from BGL. BGL has been pretty aggressive out in the market, and they've offered a 12-month honeymoon, zero price on their cloud product to any desktop user. And that's made it harder for Class to win customers, and that's why you've seen lower customer wins for Class. But in saying that, Class still won 5,000 in the quarter, and that's pretty big. If you annualise 5,000, you get 20,000. They've got 160,000 on at the moment. These guys are growing organically at greater than 10%, even in a pretty tough competitive environment. So, it's not all tears. The outlook is actually pretty robust. It's one of the few companies taking market share in the industry. And strategically, it's well positioned. Obviously, AMP is going through some trouble at the moment, and there's some potential asset sales at AMP. AMP owns a software provider in the SMSF space called Supermate. It has 7% of the market. It's got 42,000 accounts. That business could be up for grabs. Now, with BGL having over 40% of the market, Ron's out there saying he might even have more than that. It makes it hard for him to buy Supermate. Class at 26-27% is in the box seat to buy Supermate. It would be hugely incremental for the business.
Okay, guys, great answer. Can you provide an update on Bega Cheese following their acquisition?
Yep. Okay, so Bega Cheese obviously has gone through some interesting change over the last 18 months or so. It's sold various dairy assets, and invested that back into branded goods, which we think long-term is a good move. It's bought Vegemite and peanut butter, which are both fantastic, assets in Australia. Great cash flows, much more stable than dairy. Obviously, they've probably had some teething issues with switching across to consumer goods, but it does bring a long-term upside in terms of cash flows, ability to bolt on more acquisitions there. Plus, of course, they've got a good position in the dairy industry, which is going through its own rationalisation/consolidation at the moment. And Saputo coming into that marketplace from Canada, buying out Murray Goulburn has actually probably been a massive net positive for all the dairy participants, because it's probably a more rational player than Murray Goulburn was. So you should see a more rational outlook for all those guys. So look, net, we think they're doing a pretty good job, and of all the stocks we look at in the small cap space, they're probably one of the better capital allocators in an industry that's got go through cycles. So we're very happy with that position.
Okay, great. Another stock-specific question. Any update? There's a couple of questions here on Essentia. Any update on Essentia? Last 6 months, what's your view on this one at the moment?
Yeah, look, we believe the copyright pricing changes could potentially be significantly positive for Essentia. So at the moment, Meltwater has been very aggressive in the market, and they've been price discounting the market. They're paying a very low copyright fee to the copyright companies, which is basically News Corp and Fairfax. But basically, if we do the numbers, we believe that Meltwater's got about $20 million of revenue in the market. Essentia has about $100 million of revenue. Obviously, Essentia is the dominant player in the market, but Meltwater has taken share. Now, we believe Meltwater has a 30% margin, which means they're making about $6 million from that $20 million of revenue. Now, if they're paying copyright costs of, and this is just our guess, of $1 million, and that copyright cost increases, say, threefold or potentially fivefold, we believe the increase will be quite substantial for Meltwater. You're talking about potentially $2 to $4 million increase in their copyright costs, in their cost base. Now, if that $2 to $4 million increase, let's just say it's $3 million on average, goes through, that'll halve their profit here. So their profit will go from 6 to 3. Now, to get back to $6 million of profit, they'll have to increase their prices. So you're talking about potentially $3 million on top of that $20 million of revenue. you're talking about a 15% price increase for meltwater. Now, that would be very positive for Isentia, because the biggest issue Isentia has faced is that meltwater has been underpricing because of their lower copyright costs. So we actually think the copyright changes will be positive. Now, there might be some short-term pain, but we believe there will be long-term gain, because you're going to have a more rational market with meltwater paying an increased copyright cost.
Great. Okay, guys. An update on Vita Group. Do you think Telstra's issues are behind VTG? And is there any change into the new focus on the non-Telstra business within Vita Group? Does it have legs?
Yeah. Okay. So good questions. So a couple of sub questions there really. Telstra's issues on market share. Obviously, currently it's if you like, it's really forward-looking. So TPG is entering the mobile market, which is very well known. We think they're going to focus largely on the fixed mobile network as opposed to genuine mobile, so fixed wireless, sorry, as opposed to mobile. So we think the way they're building the network out is largely to attract people's home, effectively an NBN equivalent product, rather than actually mobile. So nonetheless, they will launch mobile business against Telstra. Vita Group is slightly insulated against that because it does focus more in the regional areas as opposed to city areas, and no doubt there will be some pressure on Telstra. But equally well, Telstra will need to have a strong retail presence as well. So it can't really afford to cut off its relationships with strong retailers or providers like Vita Group. So we think their position is okay, albeit that clearly competition in that space has intensified. The move by Vita into the non-invasive medical, basically cosmetic surgery, is I think, look, frankly, we see it as a low-risk strategy. They've bought 5 or 6 sites now. It's all with cash on the balance sheet. They haven't geared up the balance sheet to do it, nor have they raised a whole bunch of capital, nor have they spent a lot of goodwill buying their businesses. It's a very fragmented industry. It's a growth industry, and potentially one that could be very lucrative for Vita Group. So we think, all in all, it's a pretty sound strategy for Vita Group to be pursuing, and relative to some of the other guys in the space, it's quite low risk. So yeah, we would endorse that.
Okay. Guys, more of a question on are there any differences between the managed fund, the Spheria Small Companies Fund, and the SEC, the LIC portfolio?
Look, they're largely the same. We're trying to emulate the small cap fund with SEC, and it's in substance the same, basically. The product, one's just listed and one's unlisted.
Yep. Okay, another question. We're getting them flowing in left, right, and centre here. Any sectors that look more appealing than others, and do you see any opportunities in certain sectors?
Yes. Obviously, there are more certain sectors. We're aware of sector weight, etc. in our portfolio construction. But look, we would say that we think broadly resources have had a massive run, probably less appealing than they were going back 12 to 18 months, stating the blinding obvious, but they've had a massive run and don't look as appealing to us as they did historically. We've touched on some of the consumer discretionary areas that we think are appealing. Some retailers have been washed out or going through turnarounds that we think are appealing at the edges. We think some of the old media stocks which have been left behind and are in the process of going through massive consolidation. I think people have sort of forgotten about this, but the laws changed a year ago, enabling mergers to finally take place with old media. There's a lot of rationale to actually bring these things together in terms of ripping costs out and to compete with Facebook and Google. And even in places like America, you've got massive consolidation going on right now in old media. So Comcast bidding for Fox assets, etc., and Disney bidding for Fox, just shows you that there is scale and earnings to be gained by merging assets. We think there's a lot of potential activity there, both from a fundamental point of view in terms of cash flows, but also once the egos are put aside, there's a lot of common sense to seeing these guys get together and synergizing and reducing costs.
There's a lot of duplicate costs in the media industry. So if you look at Fairfax and Seven West Media, for example, and Prime Media, if you bolted them all together, there's massive savings in the newsroom. There's a huge duplicate cost base. So we actually think at some point there will be significant consolidation, and we own Seven West and Prime Media, and we think we'll be the beneficiaries of that. We see Fairfax as the acquirer at the end of the day.
It may happen that way. It could be a bunch of combinations, frankly, but there's a lot of rationale. And old media is also kind of reinventing itself. I think people also miss this, but if you look at Fairfax, for example, with newspapers, something like 35% of the revenue of their papers in the city has come from digital now, and that's growing rapidly. So they have remade themselves. They're advertising better. They've learned to live with the digital world rather than fight it. We think there's some positive trends going on with the old media anyway, irrespective of the fact that there can be consolidation on top of that.
Okay, guys, back to stock specific. A couple of questions on Platinum. View on Platinum and the CEO transition. Do you think this will be a success?
Look, Platinum, obviously that was announced a few months ago, and I think everyone expected massive withdrawals from Platinum. You haven't seen that. The actual fund flow is positive. I think they're doing probably anywhere from 50 to 100 million a month in terms of retail fund flow. So the business has held up pretty well. They've had succession planning in place for a while. You've seen that the younger PMs come through. Clay Smolinski, for example, is running part of the international fund now. And that, that's a positive that they've shown that they've had this plan for a while. So the fund flows have held up. They've still got 27 billion in assets under management. It's a very lucrative business. It makes a lot of money. The yield on the business is compelling. They have over $200 million of cash on the balance sheet and listed investment company assets. It ticks all the boxes for us. Yeah. In fact, they've actually de-risked the business because the biggest risk around the business was what happened with Kerr. And Kerr is hanging around there. He still is an analyst there. And the business is still trundling along.
Yeah, well, and Andrew Clifford, who's taken over as CEO, is effectively a co-founder. He's been there since day dot. So, we've met Andrew quite a few times. He's a very capable, very good investor, and obviously, will drive the company forward.
Yeah, the biggest issue Platinum's had in recent months is exposure to Asia. I mean, the Asian markets have been on the nose. The US market's held up reasonably well. You get some mean reversion in the fact that the Asian market bounces back and the US market falls. And if that happens, obviously you'll see significant outperformance for Platinum.
Guys, a question more on the product in terms of beta. What's the beta on the funds? And there's another question in here on, do you think we're late cycle? And, how will that beta play out potentially with the funds?
Thanks, Mike. Look, the funds typically have much lower beta than the marketplace. So if you look backwards for the last 12 months, the beta is about 0.7 versus the market. So we wobble around, if you like, less than the market, if that's important to people. It kind of makes sense, and if you think how we actually invest, we basically look for low risk assets with cash flows and valuations that support them. So if there is any sort of downturn, we would hope to do better than the marketplace. That's kind of how we think and invest. And so, having a low beta, low vol strategy, I think enables us to box defensively in a tougher environment.
Well, fantastic. Look, that's all we've got time for today. We will be making the Spheria webinar available on the Spheria investment website, which is www.spheria.com.au. We certainly like to thank everyone for their participation today. Some great questions that came in and great engagement. If you have any further inquiries, please do not hesitate to contact one of the Pinnacle Distribution team members you'll see there on your screen. Thank you for your time today. We look forward to chatting with you at our next webinar or in your office at our next meeting. Thank you very much and have a nice day.